Welcome to video number 6, our transaction analysis exercise in the accounting crash course. Let's look at our roadmap. We've talked about the basics of transaction analysis. Now we're going to practice transaction analysis in our exercise. So let's go through our exercise. Now this is going to carry forward in the future videos as well. We're going to imagine we're just some generic company and we sell retail goods, okay? We've got PP&E and inventory. But we're in the first year of operations, so all of our balance sheet and income statement are starting from zero. We're in our very first year of operations. We're going to have 12 transactions that occur during our first year of operations. In this video, we're going to analyze those transactions. In future videos, we're going to convert that into journal entries. We'll post the journal entries to T accounts, and we'll use the T accounts to produce financial statements. But all of these are for a future video, okay? Let's just focus on analyzing the transactions for now. What I have on the screen here is a balance sheet and the income statement of our company. These are all of the accounts that we've talked about in previous videos. You can see the balances in these accounts are all zero. Why? Because this company is only a piece of my imagination at the moment. I haven't actually engaged in any economic activities to further this company, but I'm going to start doing that this year. So let's go through our 12 transactions and let's begin populating these financial statements with our transactions. So what will happen is the transactions are going to appear in this yellow box here. We're going to analyze the transactions and decide how they should affect the balances that we see on the balance sheet and the income statement. Let's go through this first example, which is receiving $2,000 in return for ownership in the company. Remember our method for analyzing transactions. First, we want to ask ourselves, is cash involved? Absolutely. We are receiving $2,000. You see that? Cash is involved. Cash is going to go up, isn't it, when we receive this $2,000? So great. We have an easy time. Cash is going to go up. Let me just draw a little arrow there to begin with. And then the question is, well, what's the other count that's involved here? Why are we getting this cash? We're getting it in return for ownership in the company, okay? Somebody's not buying something, a product from us. That would be revenue. This isn't borrowing, okay? This isn't debt. We're getting contributed capital. Someone is becoming an owner of the company. So that's why we're receiving the $2,000 in cash, and that is the other account that we're going to use in this transaction. So let me reflect the transaction now on my financial statements. I put a plus $2,000 in the cash balance because I want that account to go up by $2,000, and I put a plus $2,000 in the contributed capital account because I also want that one to go up by $2,000. Now let me post these transactions actually into the account rather than just these pluses. I'm going to now reflect them in the balances. So now I've done that. Now cash has a $2,000 balance and contributed capital has a $2,000 balance. You can see this has been reflected in total assets, the cash has, and then the contributed capital has been reflected in total equity, and total equity is reflected in total liabilities plus equity. And the check we want to do after every transaction, we have to make sure total assets equals total liabilities plus equity. And it does, so we did a good job on this first transaction. Let's go to transaction number 2. Number 2, we borrow $1,000 from a bank. Is cash involved? Absolutely. We're getting $1,000 more of cash. Why are we getting this cash? Well, because we are borrowing the money. Borrowing funds with the promise to repay those funds is called debt. And debt is a liability. And so we were going to increase debt by $1,000 and increase cash by $1,000. And on the next part, I'm going to reflect this additional $1,000 of investment into our company in the account balances. So here we go. Now we have $3,000 of cash. How did we get that $3,000 of cash? Well, we got new ownership that contributed $2,000, and then we're also borrowing $1,000. So you can already see how the balance sheet is telling you something about the financial position of this company. What do they have? Who do they owe? And where did they get it from? We know that because of the way it's reflected on the balance sheet. Okay, let's start moving through these transactions now. Number 3, suppose we use some of our cash now. We're going to pay $500 for new PP&E. Does this transaction involve cash? Yes. We're going to pay cash of $500 and we're going to gain PP&E of $500. So we'll take $500 out of our cash balance and we'll transfer it essentially into our PP&E account. We're keeping track of the cost of property, plant, and equipment that we purchase. So now I'll reflect that transaction in the balance. You'll see my cash has gone down to $2,500. My PP&E has gone up to $500. My total assets has remained the same, and my total liabilities plus equity has remained the same, and they continue to be equal to each other. Transaction number 4, we received $200 of new inventory. We'll pay for it later. So remember when Rivian got a delivery of steel and they said, we'll pay for it later? That's what's happening for our company. Someone is trusting us. They're giving us materials. We have it now. We've got the materials and we've promised to pay for it later. So because we've got the materials, we count that as an asset that we now own. So we've got $200 worth of an inventory asset, but at the same time, we've got an obligation to pay our supplier of $200. So you can see I've increased inventory by $200 and I've increased accounts payable by $200 to reflect that fact. And when I post this transaction into the balances, let's see what happens. Total assets is going to go up by $200, and total liabilities is also going up by $200, which causes total liabilities plus equity to go up by $200. So happily, we still have a balance sheet that balances, because at the same time we received inventory and counted that as an asset. Well, where did we get it from? We didn't pay cash, but we do have an obligation to pay our supplier. So we increased our liabilities to reflect that. Okay, our next transaction is we're going to settle this liability right away. We want to maintain good relationships with our suppliers, don't we? So that $200, we don't want to owe them $200 for long. We're going to now pay that off. So we're going to remove the obligation, aren't we? Once we pay that off, we're going to remove the obligation, and cash is involved here. It's going to take $200 of our cash balance. So subtracting $200 from cash and taking away $200, zeroing out that accounts payable balance. And after I post it, now we've got less cash, but now we don't have that obligation anymore, do we? And now, again, we've got $3,000 of total assets and $3,000 of liabilities plus equity, so our balance sheet is still in balance. Okay, our next transaction. Let's sell inventory for $100 for a price of $300 on account. This is going to be the most complicated transaction we've done yet, so let's take it slowly. First, let's talk about this $100. We're selling inventory that cost $100. So here, if you look at our inventory balance before this transaction, we've got $200, and that's what the inventory cost us, remember, $200. We're going to sell $100 of that inventory. When you sell inventory, you don't have it anymore, right? So we're going to need to subtract $100 from that inventory balance. We don't have half of that asset anymore. And we are selling that asset, aren't we? So we're going to transfer that cost into the income statement under cost of goods sold. So I hope you see what these numbers presented on the screen now. We're taking $100 out of inventory and we're reflecting it on our income statement as cost of goods sold. Now let's talk about the $300. That was the price that the customer is willing to pay. Notice I didn't say paid. That's what they're willing to pay. This on account term means that they will pay us later. So we deliver the inventory to them. We took it off our balance sheet, but we didn't receive cash from them. All we received from them is a promise to pay. Where do we keep track of outside entities that owe us money? We keep track of it in accounts receivable. So here's that transaction. We're going to increase accounts receivable by $300 because our customer owes us $300. And that is revenue. We've earned that because we've delivered the inventory to our customer. We get to put it on our income statement. But since we haven't received the cash yet, we're just going to keep track of it in the accounts receivable account. Okay, the $300 of revenue and the $100 of cost of goods sold, that is a profit of $200. Hopefully you can get there intuitively, right? We sell something for $300, it cost us $100, our profit is $200. That's going to be the effect on net income, isn't it? $200. So in our transaction analysis, we need to make sure to put that $200 into retained earnings. And this is in order to check and make sure our balance sheet is going to balance. So that $200 of profit is going to increase our net worth by $200. It's going to increase our equity by $200, okay? That's it. That's the transaction. So now let me post these to the account balances and we'll see the end result of this transaction. Here now we've got $300 of accounts receivable where we didn't used to. We've got $100 less of inventory. We made a $300 sale, which cost $100, and so we've got $200 currently of net income. And that $200 of net income is increasing our net worth. Our total assets continues to be equal to our total liabilities plus equity. So we're good to go on that transaction. And let's do the next one. The next one is, guess what? We're collecting the $300 from the customer that owes us $300. So we were keeping track of that, okay? We kept calling that person. How did we know to keep calling? Well, we've got this accounts receivable sitting on our balance sheet, burning a hole in our pocket. We're thinking, hey, how quickly can we convert this back into cash, okay? We want this to be cash. So we call them, they say, okay, yeah, we'll pay you. They pay $300 to us. It's just an easy transfer. Now, sorry, I've covered it up a bit, but we're gonna take $300 out of accounts receivable, and now we're gonna receive that $300 into our cash balance. So the end result of this transaction is we've now zeroed out our accounts receivable balance, and we've received that $300 into our cash balance. Assets equals liabilities plus equity still, so we're good to move to the next transaction. The next transaction is a customer prepayment of $300. So now we're not ready for whatever reason. Maybe the customer is traveling and they say, look, I want to put a reserve on that inventory. I'm not ready to take delivery yet, but here's $300, and would you deliver that to me when I get back? We say, okay, we'll take your money. So we took the $300. That's what we're doing in this transaction. We're taking the $300 as a deposit. Well, we're receiving cash, right? Cash is involved. Cash is going to go up. We haven't earned it yet though, so we're not going to put it on our income statement as revenue. Actually, that $300 represents an obligation. It's our obligation to deliver the inventory to the customer when they're ready to receive it. So here's what the transaction is going to look like. Yeah, we're receiving the cash, but we're not counting as revenue yet. This is deferred revenue, and we will only count that as revenue once we deliver the inventory. So that represents just an obligation. So posting this entry into our accounts, now our cash is higher by $300 and our liabilities are higher by $300. And so the cash is going to increase total assets to $3,500. The increase in liabilities is going to increase liabilities plus equity to $3,500, and we're still in balance. I bet you might be able to guess what the next transaction is, which is our customer returns home. They're ready to take the delivery of the $100 of cost of inventory. They prepaid $300. We're delivering the $100 of cost of inventory to them. Okay, this is another sale transaction. Because we're delivering the good or service to our customer, we've now earned the revenue. So let me just reveal what that looks like. We've earned the revenue, so our revenue is going to increase by another $300, and we no longer have this obligation because we are delivering the good or service. So we no longer have the obligation to deliver. We did it. The other thing is we are losing the last of our inventory. We had $200 cost of inventory. We sold 100 and now we sold another 100, and now we don't have any inventory left. We're zeroing out our inventory and we're treating that as a cost of goods sold, okay? And remember, this is another $200 of profit, and that $200 is going to need to be reflected in the retained earnings account, because when we have net income, that gets reflected in our net worth. So at the end of this transaction, we now have no more inventory. We now have $400 of retained earnings. We've got $400 of net income, and that's the result of that transaction. Assets is still equal to liabilities plus equity. Transaction number 10. Remember, we got 12 transactions total. So transaction number 10, we don't do this by ourselves. We've got an employee, or maybe I'm the only employee and I'm going to pay myself. But the employee actually wants an advance, okay? So the employee hasn't earned this $100 yet. They want an advance. So imagine you're sitting in your office, your employee walks in, they say, look, I need to pay a bill. I know I haven't earned it yet, but can I have an advance of $100? Well, you want to retain and treat your employees well, so you say, of course, I trust you. Here's $100. Is cash involved? Absolutely. We're losing $100. So cash needs to go down. What goes up? Well, it's prepaid expenses. Now I am prepaying the labor of my employee. My employee is going to work for me in the future and earn that $100, but for now I'm just paying it as an advance. So I'm taking it out of my cash balance, but it's still an asset of mine. Why is it an asset? Well, an employee's promise to work for me in the future is something of economic value. It's a resource of economic value. So it counts as an asset, and I'm going to put it on my balance sheet as a prepaid expense. So here's how that transaction looks like reflected. I've got less cash, and now I have an asset called prepaid expense. They cancel each other out, and so my total assets continues to be equal to my total liabilities plus equity. And let's move to the next transaction. Number 11, the employee works, okay? The employee earns that wage. It's no longer a prepaid expense, is it? It was an asset when I was looking forward to future labor that I've already paid for, but now they've actually done the work, so it's no longer an asset, okay? Now they've earned it. So all I'm going to do is zero out that prepaid expense, and I'm going to count that as an expense because the employee has earned it, and that's what wage expense captures, is the amount earned by employees during the period. So it's going to be a minus 100 for prepaid expense, a plus 100 to wages expense. Now let's flow through. The effect on wages expense needs to flow into retained earnings, right? That $100 expense is going to reduce retained earnings by $100. And that's what's going to keep our balance sheet in balance. Reducing assets by 100 and reducing equity by 100. When you post that entry, yeah, you don't have that prepaid expense anymore, and it's also reflected as a reduction in your net worth. So our total liabilities plus equity is still equal to our total assets. The final transaction is called an adjustment, okay? So we've reached the end of our first year, and this is called an adjusting entry. We need to reflect the fact that time has passed, and that affects certain account balances. Among those is PP&E. So we bought this equipment, and equipment does not last forever. Apparently, we've determined that we think our equipment is going to last about 5 years, and now we're 1 year has passed, and so our equipment has lost 1/5 of its value, which is $100. We're going to reflect that like this. We're going to treat that as depreciation expense, which is the systematic loss in value of our property, plant, and equipment over time. We're also going to reduce our PP&E balance to reflect the fact that that asset is now less valuable than it was at the beginning of the year. So posting that transaction, remember the increase to expenses of 100 is going to reduce retained earnings by 100, and that's going to keep our balance sheet in balance. Our assets decreased by 100, our net worth decreased by 100 because of the expense, and our assets continues to be balanced with our liabilities and equity. Okay, that was the transaction analysis for this exercise. You can see at the end of the year, here we've got a balance sheet, and we can learn some information about this company. We've got a ton of cash, but we don't have any inventory. We've got nothing to sell. So maybe you would tell managers, look, you really need to start stocking more inventory so you're ready in case more customers want to come and buy inventory from you. We've got PP&E that has 4 years left on its useful life. We've borrowed some money, we've got some contributed capital, and we also made a profit this year. So we've got some retained earnings in the operation of our business. Okay, that was the exercise for the transaction analysis. In the next video, we're going to convert those transactions into journal entries. And this is the way accountants actually do account for transactions. And we're going to start in our next video with journal entries.